So Real Capital Analytics, hopefully a lot of you are familiar with our name. We track transaction activity around the world in about 160 countries these days. What I'm trying to use that big database of about sort of $17 trillion worth of activity around the world to give you some sense of what's going on in Europe, but also in Germany in particular. So I've only got one slide at the European level, and this is it. It splits European transaction volumes in euros into quarters, and it splits it into individual assets, so single assets trading, portfolios and entity levels, so the big sort of mergers and acquisitions. But one of the things that comes out is how Europe, with the exception of a couple of big sort of spikes at the end of the year, the fourth quarters, there has been a little bit of a downward trajectory over the last few years as the volumes have slowed, as a lot of money has flown into the markets, but we're starting to see a slowing across the global real estate markets at this time in the cycle. And Q1 compared to Q1 last year was down 16%. So a little bit of sort of a significant slowdown in the European market as a whole. But when we start to drill down, we see a real mixed picture at the country level. Germany's at the top, and that's something we'll come back to in a few moments. But what we've done on this chart is taken Q1 17 and compared it to an 11-year average. So rather than just compare to previous years, which gives you a little bit of a skew because particularly 2015 was significantly strong. But if you compare it to the long-term average, you can get a sense of which countries are punching above their weight, which are seeing more capital than usual and which aren't. The UK, the second one down, you can see is significantly below its long-term average. It's about 43% down in Q1 versus the previous Q1, but you can see it's significantly down on that long average. Germany, however, is significantly above its long-term average, so it's getting more capital than traditionally it's been getting. The only real other country that's seeing that same significant increase is Spain. France is actually down considerably as well. So of the top four there, you can see Germany well ahead in terms of volumes in Q1, but also well ahead of its own 11-year average. And the big news there is that Germany took the number one spot from the UK in terms of transaction volumes in Europe. It took it in Q4 last year, which also meant it took the whole of 2016 as number one, and that's carried on into Q1 17. And you can see it's not just by a slight margin, it's by about 5 billion euros difference. As I say, the UK down 43% in the quarter, Germany up 33%. So significant sort of positive performance from Germany. Why is that? Well, it's largely due to cross-border capital. As you can see here, that Germany has not only become the number one market in terms of overall transaction volumes, is also the number one market for cross-border investors to go to. And actually, in terms of share of cross-border capital in Europe, Germany's now at 28% and the UK is at 20%. And you can see a real switch over in the last few quarters from where the UK has dominated through this cycle, taking more of that cross-border capital than all of the other countries in Europe. Now Germany's taken that number one spot. So overseas investors are clearly seeing something in Germany that they like and they want to put more money to work. Where's that money coming from? The US is number one on this chart for both 2016 and year to date. The year to date numbers are here in grey. Hopefully you can see the grey numbers at the back. One of the things to sort of highlight really there is that there is a little bit of skewing in the year to date numbers, which actually bring us up to date a couple of days ago, so they're sort of reasonably real time. The little bit of skewing is Office First, which is included in those numbers, so that's Blackstone's investment there, and that also leads to Blackstone being the number one investor into Germany. But you can see there's a whole slew of money that's coming in. I'm going to pick up maybe a little bit on South Korea. South Korean investors are particularly active in Germany. It doesn't quite look like it in year to date, but in the last 24 months there have been 12 investors from South Korea that have targeted Germany and invested in Germany. There's only been one South Korean investor who's put money in the UK. So Germany's clearly attracting a lot of that sort of South Korean money that's starting to sort of come out of South Korea and go global. But you can see a whole list of different types of investors, private equity, core investors, pension funds, all sorts of different money that's interested in Germany at the moment. Well, what about the domestic investors? They're also very active. So we have investors there who are You can see sort of from the grey bars, which are the Q1 numbers, you can see that 2017 slightly below 2015, but it's the second most active quarter that in the start of the year that domestic investors have been in Germany. It's up 60% on last year, so it's not just cross-border money that's driving the German market, it's also domestic capital that's interested in the market, which is a great confidence boost for investors generally. You never want to see a market where cross-border investors are driving it and domestics are selling out. That's a bad sign, but in this case we've got domestics coming in, so it's a pretty confident and positive story. And also German investors, if I highlight on this chart, certainly what you see in this, in the net column, is that on both the latest quarter and also over a 12-month period, German investors overseas have been net sellers of overseas real estate, which you could have, it's always hard to sort of say where that capital's then going once that money's sort of been taken back into the funds, into the businesses. But you could argue that some of that is being repatriated at home. If we're seeing a huge surge in domestic activity, and there's overseas money is being sold, then maybe some of it's coming back into the German market itself. So German investors, net sellers overseas, net buyers at home. Which markets are seeing the most money? Berlin is by far the sort of largest market, and it's also the only market, except Stuttgart, but that's a couple of deals that have driven it. It's also the only market where more than 50% of the activity is actually cross-border. All the others are sort of more a higher percentage to domestics and cross-border. But you can see here Berlin certainly sort of high up on that chart, so really sort of driving along. The interesting thing in the numbers though is sort of if you look at Berlin in terms of lot size, the average deal being done in Berlin is 26 million. A lot of overseas money, 26 million. Munich and Frankfurt is 33 million. So there's a big sort of divide there between sort of the markets. Berlin is where you can go and you can put capital to sort of to play if you're looking at smaller deal sizes. Frankfurt's obviously got the towers, and Munich's just generally more expensive. So you're sort of seeing sort of a difference in what you can get, and maybe that's one of the reasons why a lot of investors are attracted to the Berlin market. Just in terms of ranking, these are our sort of rankings of activity in Q1. In terms of which markets, London is well ahead of everyone else. It looks like that's probably an impenetrable lead that London has on the market. I'm not sure any of these cities are going to catch London, even though London is down 34% in the first quarter. But you can see now that the top Berlin, Munich and Frankfurt are all in the top 5. And you can see if I just highlight the German markets in this top 30, you can see a lot of them have been positive movers. The only one that's moved down is Dusseldorf, Cologne and Frankfurt have stayed steady at their positions, but you can see how Berlin and Munich have both leapt over Paris and pushed Paris down into the 4th spot for the first time in a long time. Paris has sort of been seen less attractive, maybe due to the uncertainties around the elections. Obviously Brexit has an impact in the UK, and then you've got sort of the German markets, the stability, the solid markets, seeing a lot more capital flow into them. Outside of these A cities, you're seeing sort of the domestic investors who would tend to be driving the A city markets. If you look at domestic investor capital, 40% of it is going into the non-A cities, which is shown on this chart. And in the orange, which is the cross-border investors, only about 30% at the moment of their capital is going into non-A cities. So A cities is where the cross-border money is going. Domestic investors tend to be having a little bit more exposure to the non-A cities. Interestingly though, if I just quickly zip back, Leipzig, which is on here, which is not traditionally included in the top 7, has actually jumped over Stuttgart in terms of the size of the market. It's jumped up 23 places in terms of our European ranking of markets. So Leipzig, a smaller sort of I guess just below the A city, typical A city rankings, certainly seeing a lot of investor interest. Sectors are in demand. Offices, normally the biggest sector, still is. I'm actually going to focus not on the top there. You can make those out for yourself. Again, split into domestic and cross-border. Just going to focus on a couple at the bottom, which is quite an interesting story. Senior housing, which is growing, still small bars, but it is growing quite fast in a lot of countries around the world, particularly Germany as well. But it's actually non-German investors who are taking the lion's share of that sector. A lot of US, a lot of UK specialists who are interested in that market. On the development site side, still small numbers, so not a lot of risk being taken. what risk is being taken by domestics. So it's domestic investors who are taking on the development risk in Germany and not cross-border investors. Just a few quick slides on pricing. Germany's getting very expensive. I think that's pretty clear from some of the yields. These yields sort of are really the top end of the market in terms of the sort of the best assets in these countries. And what we're seeing in Germany, it's kind of getting reasonably close to Hong Kong pricing, which is a little bit worrying. So it's now below 3%. Right at the bottom here, this is the sort of the change in basis points of the sort of the top end yields in offices. From its long-term average. Germany, across these major sort of metropolitan markets, has shown the largest basis point change. The only other market that sort of is similar in that sort of basis point move over that long-term average is Sydney. Also, another market which has seen a huge flow of cross-border money in the last few years. So that's really driven down that top end of the market. So Germany, you can see, sort of very highly priced. However, on the positive side, this is taken data from our own commercial price indices. These indices are prior sales, so they're looking at the same assets changing hands over time. Very similar to house price indices that sort of moving, have a similar repeat sale model. These indices are not yet available. We're actually releasing them in the summer this year, but I've just sort of used them here because what it kind of shows is that while the pricing is quite expensive in Germany, Germany is still only just recovering in terms of sale prices. There's still plenty of recovery room. It's only really back at its previous levels. Whereas if you look at London and how far London recovered and how quickly London recovered, it started recovering back in 2009. You can see how much it shot through its previous levels and started to sort of plateau now. This is all commercial. This is retail, office, and industrial. Starting to plateau at the top there, whereas Germany has got some room to, if you expect it to sort of overtake its previous levels, it's got some room to go. And also down the bottom there is Amsterdam. Amsterdam is a market which is only just starting to recover. Now it's cleared a lot of its vacancy issues, but starting to recover as it's seeing cross-border money going quite strongly. So that pricing is recovering. But if you look at that and you think about where rental levels are in Germany as well, there is some sort of still room for recovery, despite the fact the yields are at such low levels at that top end of the market. But also, Germany is also seeing a huge amount of capital still going. This is from INREV's Investment Intention Survey. Germany has been ranking sort of number one for a few years now in terms of investor preferences, so still a lot of capital focus on Germany, so we could perhaps see those yields get pushed down even further over the next few quarters, the next year or so, as that capital continues to sort of target and try and attempt to get into the German market. And also there is huge amounts of capital still out there. So again, from INREV's survey, just showing sort of how investors across all of the regions are looking to increase their allocations. Germany is high up on that allocation target list. So therefore, you'd expect to see more capital keep targeting the German market.